Credit cards, the world's plastic version of an IOU. Credit cards are used in over 140 countries worldwide, with usage increasing by the year. There are millions and millions of people who rely on credit cards, which suggests they're pretty popular. But they can also be pretty dangerous, especially because a lot of credit card companies target younger users who don't really understand, or in some instances even care, how money and credit work. So they're handed credit lines and they treat it like free money. I mean, you give a college student $10,000 in credit, lots of those kids are going to start thinking about the castle they want to rent for their birthday, or the retro Mortal Kombat arcade game they want for their dorm room, even though it'll never fit inside. Maybe the luxury car they want to lease so that they can live out their Fast and Furious fantasies. Now, credit cards can be beneficial when used wisely, but they can also be an albatross when used carelessly. And we'll talk about both. But first, let's take a quick look at how exactly credit cards even begin. In the 1900s, credit was based upon intimacy and trust. Sounds like a relationship, doesn't it? Well, that's because it was one. Shop owners would extend credit to the best customers they had, if they were trusted to pay the debt by the end of the month. These customers would typically be given a token or maybe a piece of paper that marked them as being allowed to buy on credit, so that they could present that coin or paper to the store and walk out with the goods they wanted, as long as they paid their debts by the end of the month. This helped to keep things honest. Now, over time, that coin evolved obviously into cards, but even when it became cards, it was still rather burdensome to walk around with a card for every store you wanted to have credit in. I mean, people would have wallets filled with these things. Thus, in 1950, New York City, the first incarnation of the credit card was born. It was cardboard, and it was called the Diners Club card.
Nearly 25 years ago, Diners Club introduced the first executive credit card. Today, around the world, Diners Club is still the first card.
Why, yes, that is terrible 1970s video footage. Thank you for asking. The Diners Club card basically created a network of stores that would allow customers to use this one card, the Diners Club card, for credit. Thus, rather than having to create individual credit cards or coins or papers for each store that a person wanted to have credit with, they could use one, the Diners Club card, as long as they were shopping at a store that participated in the Diners Club network. In the first year, the Diners Club network had 28 restaurants and 2 hotels participating, meaning that people could use the card to buy on credit at any of those restaurants or hotels. By the end of 1952, the network had grown to include 70 businesses. Now, this wasn't exactly like the common credit card. It would be more like what we would consider a charge card, because customers still had to pay their debts by the end of the month. Otherwise, the card would be deactivated. But still, this laid the framework for what was to come. Jumping to the late 1950s, 1958 to be exact, California was the place. Because California knows how to party. On credit. And you know what else California knows how to do? Apparently, they know how to borrow money. Bank of America wanted to get into the credit game, so it sent out a credit card to all of their customers. They sent out roughly 2 million cards and had a network of about 28,000 businesses in their network. But here's the problem. They sent these cards out all willy-nilly. They weren't discriminatory at all. Sure, Al the accountant got one, and businessman Bob got one, Sally the seamstress got one, but so did Great-Grandma Jenkins, the 90-year-old who lived in a shoe, and unemployed Earl, and Gamblin' Gary, and Shopaholic Shirley, mean, they were like Oprah. You get one, and you get one, and you get one. Everybody gets a credit card.
Another one.
What, another credit card?
Another one.
Mm-hmm. Okay, here you go.
Another one.
This is starting to feel a little irresponsible, but all right.
Another one.
You're ambitious. I like that. Hey, why not? Let's just give credit cards to our credit cards. Let's just get wild with it.
Another one.
All right. Somebody's going shopping. You know you got to pay us back though, right?
And another one.
Point being, a lot of people got credit cards, and some of those people probably shouldn't have gotten credit cards. Of course, this meant that the company lost lots of money due to default and fraud. I mean, you can't just start giving away credit cards and expect people not to treat it like free money. Especially back in a time before credit cards were really a thing. I mean, just imagine you were amongst the first people to be given credit. Someone comes to you and they say, hey, here's this card. You can use this card to buy stuff. Don't worry about it. Just pay us back later. I mean, how many people were sitting there thinking like, all right, idiot. Sure. Yeah, I'm going to pay you back later. Oh, yeah, sure I am. But it still benefited the banks because it showed that there was a cultural interest in using credit cards. In other words, people would use it if they had it. And it helped normalize the use of it. In other words, it taught them the behavior of using cards to pay for things, right? If you want people to change their behaviors, you need to give them time, encouragement, and incentive to do it. We see this nowadays where more and more people are using their phone apps, for example, to pay for things as opposed to using cash or even cards anymore. So that cultural shift happens when people start modifying their behavior and get comfortable with doing something new. In this case, using credit cards. Nobody was using credit cards, so in order for people to start using credit cards, it had to become acceptable and convenient and encouraged. Now, within a few years, Bank Americard, which was the name of their credit card, expanded beyond California and across the US. Bank Americard would go on to become what is today known as Visa. That's right, little old Bank Americard that started in California started injecting itself with some of them crack steroids. And by crack steroids, I just mean mass distribution. But it became the monster known as Visa, or as some of us refer to it, it who shall not be named. Today, there are 4 major credit card companies. They're not the only ones, but they are the biggest worldwide. And those are Visa, Mastercard, Discover, and American Express. There is a difference between them, so we will discuss them separately. And we'll start with Visa and Mastercard. Visa and Mastercard are 2 of the widest accepted, globally recognized credit card companies in the world. But contrary to what a lot of people believe, Visa and Mastercard do not lend people money. So if somebody has a Visa or a Mastercard credit card, that's cool, but it's not those companies footing the bill or extending you credit. Most of the interest that you pay doesn't go to them. The late fees generally don't go to them. And they're not in the business of lending money because they're not lenders. They're credit card networks. Basically, they partner with the banks and the credit unions, and they are the ones that lend the money. They are the ones that get the interest payments. So you got to imagine, if every bank had their own credit card, that would mean that every store that wanted to accept credit would have to establish a relationship with each and every bank. So somebody comes in with a card from Citibank. Well, that store would need to have a relationship with the Citibank so that they can accept payments from Citibank. Another person comes in with a card from Chase Bank. Well, now the store needs a relationship with Chase Bank as well to accept payments from Chase Bank. And then they would probably have customers who use smaller banks. All right, you got a dude with a credit card. Store owner asks, okay, so which bank is this from? The customer says, this is from Belgian Waffle Bank. A Belgian Waffle Bank? Okay. So now the store has to deal with Belgian Waffle Bank. Maybe another guy or a gal comes in with a credit card. Store owner asks, which bank is your card from? And he or she says, oh, this is a Me Tarzan You Jane Bank. Me Tarzan You Jane Bank. What the hell? Okay. So now he's got to establish that connection with Me Tarzan You Jane Bank. Maybe somebody else comes in with a card from Superman's Dirty Underwear Bank. The store owner says, Superman's Dirty Underwear Bank? What the? Are these real banks? Do I have to call all these banks now? It would become a full-time job to establish these connections with every bank. Or the alternative would be to just not accept credit from every bank, but that would cost stores sales. So, what companies like Visa and Mastercard do is they work as kind of a conglomerate of sorts. They become the one-stop shop, the middleman, the connector of all banks. So stores don't need a relationship with each bank. They just need to accept Visa or Mastercard. And if they do, they can accept payments from any banks that are part of that network. Much easier, right? So now, you got a card from Me Tarzan You Jane Bank? Is it Visa or MasterCard? Yeah? No problem. Give me the money. So basically, they create an interlinked web in which customers, no matter what bank they have or what business they're visiting, can use one simple card to purchase whatever they want. They have established the collective connection between the merchants and the banks under their umbrella. It's kind of like being able to travel the world and communicate knowing one simple language. In the world of consumerism, Visa and MasterCard are that language. So here's how it works. First, when you make a purchase with a credit card, there are 5 participants involved in that transaction. You have the customer, that's the person buying stuff. The merchant, that's the store. You have an issuing bank, that's the bank that is lending the customer money. The acquiring bank, that's the bank that processes the payment on behalf of the merchant. And then you've got the credit card network itself, which is essentially like a middleman connecting everybody together, kind of like an 8th grade prom chaperone trying to get the girls and the boys to talk to each other. So a person wants to make a purchase with a credit card. They give the card to the merchant. The merchant swipes the card or scans the card or scans the app code or whatever. This, basically, stated as simply as possible, contacts the issuing bank. Let's say it's Bank of America. Bank of America checks to see if the customer has enough money on their line of credit to cover the cost of the purchase. If so, they'll tell the credit card network, it's a go. We approve it. The credit card network, let's just call it Visa, then tells the acquiring bank that it's approved, and the acquiring bank then tells the merchant that the purchase has been approved and that they can go ahead and finish up the transaction. Now, of course, this all happens in the matter of seconds. So to illustrate, let's say Tom is at the ballpark and he wants to buy a hot dog with his credit card. The hot dog cashier swipes the card, and the acquiring bank is like, hey, Visa, what's up, girl? How you living? So check this. This dude is trying to buy a hot dog with this plastic. Can you check with your people and see if we could get this going? And the credit card company, let's say it's Visa in this case, they say, well, howdy dowdy, sure thing. Let me check with my people over here on the issuing side, and I'll get back to you. So then that credit card company hits up the customer's bank, the issuing bank, the ones that lend the money, and it's like, well, yeehaw, Bank of America, listen, this is Visa calling. Your boy, Tom, is trying to buy himself a hot dog. Are you going to front him that money? And then the issuing bank will say, yay or nay. So in this case, the bank, let's call it Bank of America, will say, who, Tommy? Yeah, Tommy's good. I'll give him the money, no problem. You could go ahead and approve that purchase, because then I'm going to charge him an extra 20%. And Visa says, well, skippity-doo-dah. Okay, cool. I'll let him know. Catch you later. And Visa contacts the acquiring bank and says, hey, y'all, hot dog is approved to go. Smoother than a cowhide baked in a Sunday clay oven. I'll tell you what. The acquiring bank then says, all right, girl. Good looking out, player. Thanks for keeping it real. And then sends word to the merchant to give the man his hot dog. Now, perhaps that was all a little convoluted sounding, But the point being that there's a bunch of different people involved in the transaction. But it's not people. This, of course, all happens digitally and there is no one actually talking to anybody else. It's just the systems talking to each other. And that is how Visa and Mastercard work. So you might ask, well, then how do they make money? Well, they make money by charging a host of fees every time a credit purchase is made. They got transaction fees, processing fees, international fees if the purchase is done between two countries. And although these fees are generally small, they add up a lot given that there are millions of transactions a day. Discovery and American Express, on the other hand, work similarly with one important distinction. They are their own issuing bank. Although sometimes they may work out deals with certain banks, essentially they are typically the lenders themselves. So whereas with Visa and Mastercard, the banks or the lending institutions are usually the ones taking most of the risk, American Express and Discover take on a higher risk themselves because they are often the ones lending the money to customers. And as a result, they often charge higher processing fees, which is why some stores do not accept them, particularly smaller shops. If Visa charges a 1% fee and American Express charges a 2% fee, that may not seem like a huge difference, but it adds up. Thus, one major reason why Visa and Mastercard are more commonly accepted worldwide. Credit is a term that refers to how trustworthy someone is seen when they're borrowing money. People with good credit are deemed reliable. People with bad credit are not. Credit also refers to the amount somebody borrows. So if you have a credit limit of $1,000, that means you can borrow up to $1,000. So essentially, when you buy something with credit, you're essentially using your reputation to make purchases. Now, credit is offered through things like credit cards, mortgages, business loans, student loans, things like that. And it's so pervasive that most people globally use credit at some point in their life. Now, before we go any further, first and foremost, let's cover a couple of terms that you should probably be aware of. The first being the word principal. Now, you know that creepy guy that ran your school? You know, the guy whose office you never wanted to end up in? Yeah, you know. The guy that always smelled like old bologna? Yeah, that's the guy. Well, that's not who we're talking about, so relax. There's no bologna boys up in her. By principal, we're talking about the amount of money you have borrowed that you must pay back. This does not include any interest, it's just the exact dollar amount that you borrowed. Thus, if you spent $5,000 on your credit card, the principal is $5,000. If you borrow $7,000 to buy a car, the principal is $7,000. It's the exact amount you borrowed. Interest is the sum or the fee that you have to pay to borrow the money. This is on top of the principal. In other words, interest is extra money that you have to pay in addition to the money that you borrow. And you have to pay this simply because it entices other people to lend you cash. If you didn't pay people interest, why would they lend you money? This is what benefits the lenders and keeps them interested in providing money to people. It's how people make money by lending money. Simple enough, right? Now, let's talk about APR. The term APR stands for annual percentage rate. APR is the yearly percentage rate that someone must pay in order to borrow money. APR is charged incrementally over the course of a year. In other words, the borrower will pay 1/12 of the APR each month because there are 12 months in a year. Now, when you borrow money, you take out a loan, you use your credit card, then the interest rate that you're going to pay is usually quoted as an APR. Thus, if you borrow money with a 10% APR, that means you will be charged 10% of whatever your debt is over the course of the year. Now, how much money you owe in the end depends on how much you borrowed, and it also depends on what the interest rate is and whether that interest rate is simple interest or compounded interest. Simple interest is when the lender charges a percentage of the principal only. For example, if you borrow $100 for 1 year, the 12% APR, and we're choosing 12 just to keep the math easy. Credit cards often have a higher APR than 12, often between 15 to 25%, depending on your credit score, but let's just keep things easy. If you're paying 12% simple interest annually, then you are going to be charged 12% for the year, or the equivalent being 1% of whatever it is you've borrowed per month. But no more than that. That's it, just 12% of the amount you've borrowed over the course of the year. So in this example, because you borrowed $100, you're going to be paying an extra dollar per month. 1% of 100 is $1. At the end of the year, you will have paid the equivalent 12% or $12. So altogether, you borrowed 100 and you're paying back $112. 100 being the principal and 12% being the interest. If you'd like a mathematical formula that you can use to determine this, here you go. The principal times the interest rate times the amount of time you borrow it for. This will equal the amount that you owe. So $100 times 1.12, because it's technically a fraction. So the 1 stands for your principal, and the 0.12 stands for the extra percentage that you'll have to pay in interest. And then times 1 because you're only borrowing it for 1 year. This will equal 112. Simple interest. Simple mathematical formula. If you changed it to 2 years, you'd owe $124, 12% per year. Now let's look at compound interest. Compound interest can get a little bit more complicated. This is where things get tipsy-topsy whirly-dervy. Compound interest is when the lender charges you a percentage of the principal and a percentage of the interest as well. In other words, you're essentially paying interest on your principal, again, that's the money that you borrowed, and interest on your interest. So you're paying interest on all the money. Even though it's called an annual percentage rate, a lot of credit cards or loans compound the interest monthly or even daily. So for example, if they're compounding daily, that means they're charging you 1/365th of the interest owed per day. And then the next day, they're charging you that same 1/365th percentage again. But now you're not just paying that 1/365th percentage on the principal, you're also paying it on that little bit of interest you accrued the day before, so on and so forth. No. So compound interest can add up a lot faster than simple interest, depending on how often they charge you that interest, or compound it, as the bank nerds call it. So over the course of a year, instead of owing $112 like you would with simple interest, you might owe closer to $112.75. Not a big deal, not a huge difference, but let's see how it plays out using bigger numbers. Now let's say you have a $10,000 credit limit, and your credit card is maxed out. Let's say your APR is 15%. We'll go low. Let's say you owe it for 2 years without paying any of it off. With simple interest, you'd owe $13,000, an extra $1,500 per year. With compound interest, after 2 years, you'd owe $13,497.76. So this compound interest can start to add up, especially when you take on long-term credit, like mortgages or house loans, which are often for 30 years, and when you're borrowing a lot of money. When you have those circumstances, you wind up paying a lot of extra money over time, and that could add up very quickly.
Surprise, mother.
If you'd like a mathematical formula, this is the formula for determining compound interest. Now, it's important to note that you do not need to understand the mathematical formula itself. You don't have to memorize it. It ain't going to be on no test. You don't got to sit there with your little notepad and try to do long division. We're in modern times. This is the technological age, baby. There are many compound interest calculators available for free online, accessible through a simple Google search or whatever your preferred search engine is. So you can just put the numbers in and it'll do it for you. So you don't necessarily need to know the formula itself. You just need to understand the concept. Compound interest charges you interest on your principal, which is the amount of money that you borrow, and the interest that you are accruing every day or every month or every year as well. It continues to charge you on everything you owe all together, as where simple interest just charges you on the original amount of money you borrowed. Of course, most loans and lines of credit will charge you compound interest simply because they make more money that way. So, an easy way to remember this is that simple interest keeps things simple. Compound interest compounds it into your head that you owe money. Compound interest is like a couple of mafia goons kicking you on the floor until you pay up every penny in your pockets. Well, it's not exactly like that, but kinda. Anyhow, good news is that this concludes the math portion of the class. So I hope I haven't lost your interest. Get it? That's a pun. I can feel you dug that. Credit cards are one of the most casual loans you can get. I mean, they allow you to purchase almost anything you want without having to justify it to anybody. Unlike mortgages or business loans, for example, for which you normally have to apply, justify that the loan is needed, and then persuade the banks or the lenders to trust you, to trust that your business idea is valid or that the amount that you're paying for the home is acceptable. Credit cards can be a bit more loosey-goosey. You can use them for whatevs. You want to use it to buy that new entertainment system? Aight, you got it. You like those squeaky bunny slippers that you saw at Target? You want to throw them on the plastic? Okay, do your thing. You want to buy yourself a set of fangs and pay to have your name changed to Vesper the Vampire? Okay, we're not asking questions. You could do whatever you want. That's not weird at all. Point being, you could use credit cards to buy whatever you want. You simply have to pay a moderate to high interest rate. That's it. Now, credit card companies offer credit limits to people, which sets the amount of money that you can borrow before maxing out your card. This set limit usually depends on your credit score. The higher your credit score, the higher the credit limit you'll have access to. The more money you'll be allowed to borrow, and the lower the interest rate you'll have to pay. Now, credit card holders are expected to make monthly payments towards their credit debts. Regardless of however much money you owe on the card, you're supposed to contribute to paying it down every month, or even better, pay it off altogether. But there's usually a bare minimum amount that they're willing to accept from you, and this is called your minimum payment. The minimum payment is the lowest amount of money that the credit card company will allow you to pay them for the month based on how much you owe them so far. The minimum payment needs to be made in order to remain in good standing with them. Now let's imagine you run up a $1,000 balance on your credit card. The credit card company doesn't expect you to pay the whole thing off immediately. Actually, they don't really want you to pay the whole thing off immediately because the longer you owe them, the more interest you're going to have to pay them. Right? The more interest that will be added to your balance. Thus, the richer they get. But they do want you to pay something. And while there is no set standard formula to determine what the minimum payment will be, most companies set the minimum at 2 to 3% of the total amount that you owe. Now, paying this small amount every month can result in the borrower paying back the debt over the course of years and years and years, with the APR being charged constantly and consistently. Now, in these cases, the borrower winds up owing far more than the value that they actually borrowed to begin with. And this is how credit makes money. This is how people get rich off these credit cards, babe.
God damn it!
I mean, these banks, these credit unions, they would love people to just pay the minimum amount every month for the rest of their lives. It'd be great for them because it keeps the income coming in. Now, most people who pay credit cards don't just pay the minimum payment. Credit card holders can pay more than the minimum payment required for sure. They just can't pay less than a minimum payment, or at least not without being penalized. Paying less than the minimum payment or missing the payment altogether is going to result in penalty fees that can range between $20 to $40 per missed payment. Additionally, if you miss payments for more than 60 days, your credit card issuer can increase your APR. That's right. So you owe them money and you're not paying them? Well, they've got the solution. They're going to make you owe them even more money. Why? Because kick you when you're down. That's why.
Hey, do you mind paying for this? I don't have any cash.
Sure, I'll just put it on my credit card. I'm never going to pay it back anyway.
So that's something you might want to keep in mind as personal debt continues to increase all around the world.
What's happening? Your mom is fat! Fat hoe!
Now you may ask, what determines how much interest you will pay on your card? Well, there's a few things. First off, prime rates. Prime rates refer to the lowest amount of interest that money can be borrowed for. It's the best you can get. Every country has their own prime rates, and these tend to change over time. The second thing is the borrower's credit history and their risk evaluation. In other words, how trustworthy the person is to borrow the money and pay it back, which is often determined by a credit score. The more trustworthy you are, the better interest rate you'll get. And by better, I mean lower. A few other factors include payment history. If you're the type to make late payments or fail to pay altogether, they may drastically increase your interest rate, as we said. Promotional offers. Sometimes they'll try to entice customers to sign up for their credit card with special deals, usually by offering a grace period, which is a certain amount of time that you do not need to pay interest, usually the first 6 months or something like that, which would mean that you can essentially use your card to pay for things and you wouldn't need to pay them back. There would be no interest tacked on for the 6 months or whatever grace period they give you. It's a really good way to lull you into a false sense of security if you don't know what you're doing, but I digress. Also, some cards charge different interest rates for different services, such as cash advances, which is when you can use your credit card to withdraw cash from an ATM, for example, or balance transfers, which is where you move debt that you owe on one credit card to a different credit card. So in other words, you're using one credit card to pay off what you owe on another credit card. These types of services may cost even higher interest rates than your credit card does itself. So, always read the fine print carefully. Now, we've talked about simple interest and compound interest. Let's talk about fixed rate and variable rates. A fixed rate is an interest rate that remains steady. This means that the borrower knows what the APR will be from the beginning of the loan until the end. In other words, it's not going to change. The APR is whatever you've been told it will be, and that is the percentage that you'll be paying until the loan is paid off. In other words, the interest rate is fixed in place. Now, the advantage to this is that the borrower knows exactly how much they're going to owe. No surprises. A variable rate, on the other hand, is an interest rate that fluctuates. Sometimes it's referred to as an adjustable rate. But either way, it's defined as an interest rate that can change, and there's nothing you could really do to avoid the rate increasing or perhaps even decreasing. Not that you would want to stop it from decreasing, but you have to be aware that variable rates vary. Now, the overwhelming majority of credit cards use variable interest rates. There are some credit cards that offer fixed rates, but they're typically only fixed for certain periods of time. So, for example, you may get an APR that's fixed for 2 years, but after that 2 years, the interest rate may increase. Adjustable rate credit cards will often charge you whatever your country's prime rate is, plus a certain percentage on top of that. So because prime rates tend to change, that can often alter what the variable rate is. Then you also have what are called teaser rates. Now, teaser rates are rates that a company offers to new customers in order to convince them to take out the credit card. Because these companies are trying to get new customers, the teaser rate tends to be much lower than usual. Now, This is done as a marketing tool to get more customers. It promises lower rates for a designated amount of time. For example, as we mentioned earlier, nowadays it's very popular for a lot of credit cards to offer a 0% APR for the first 6 to 12 months, which again is called a grace period. So a potential customer hears this and they may sign up for the card. And then they can use the card for the next 6 months or whatever without having to pay any interest on it. And the hope, at least on behalf of the credit card issuer, is that they become very comfortable using this card during that grace period, since they don't have to pay any interest on anything. And when that grace period ends, the customer has become accustomed to using the credit card and they continue to use it. Another thing that they're kind of hoping for is that the customer who's using the credit card during that grace period is running up a debt on their credit card that they're not paying off, so that when the APR kicks in, they already have some debt that could be charged interest on. Of course, the third thing that banks hope for is actually the major thing, the one most important thing that they're hoping for, which is that the customer does both, becomes comfortable using it, accustomed to using it all the time, and that they've also run up a debt that they have to pay interest on. That would be the golden grail scenario for the banks, because now they get that money and they've got themselves a new customer who has an established behavior. Yeah, that new customer loves their card so much. That, for the credit card issuer, is the perfect scenario. Now, believe it or not, you have options when it comes to credit cards as well. So let's talk about the various types of credit cards. First, you have your standard credit card. This is your typical credit card that offers your basic line of credit. I mean, it could be offered to anyone 18 or older, as long as they meet necessary requirements, whatever they may be. Every card has their own. These are pretty much straightforward. The credit card issues you a certain line of credit. That's your credit limit, which is the most amount of money you can owe the bank at one time. So if you have a $10,000 credit limit and you spend, let's say, $5,000 one month, I mean, who knows? Maybe you buy yourself a pet whale or you get yourself a golden scarf or something, but you pay that $5,000 back, and the next month you still got $10,000 credit limit. You can use the $10,000 credit as many times as you want. You just can't owe the bank more than $10,000 at one time. If you pay back the money you borrow, then of course the amount you owe decreases. So if you buy something for $10,000, let's say, until you start paying some of that off, you can't use that card. Now, the credit limit can vary, again, depending usually on your trustworthiness and your credit score. Some may be given a $5,000 credit limit. Some may be given a $500 credit limit. Some much higher, some much lower. It really depends on how the bank determines your credit worthiness. The interest rate will also vary as well, depending again on how much they want your business. The more trustworthy you are, the more they want you as a customer. Now, when you're considering a new credit card, one of the most important things you have to consider is the APR. How much interest they're charging you. Because even 1 or 2 percentage points can make a huge difference. If you want a credit card, your goal should be to get one with as low an APR as possible. I mean, all things considered, circumstances aside, if you had a credit card with a $1,000 credit limit but a 10% APR, or you had a $5,000 credit limit with a 30% APR, that $1,000 credit limit is superior if you're trying to avoid accruing debt. Now, of course, the $5,000 credit limit would give you more opportunity, it would give you more purchasing power, more spending options. It's going to charge you a lot more money, it's going to charge you a much higher interest, but if you pay off the balance monthly, you may be able to avoid paying that APR altogether. So, when choosing a credit card, one of the other important factors you have to consider is your own spending habits and your own ability to pay your debts on time. Now, beyond your standard credit card, you have something called rewards cards. Now, these are the types of cards that offer rewards or perks to customers based upon how much money they spend using their credit card. Companies offer these rewards for 2 primary reasons. The first It's a way to compete with other credit card companies. Credit card companies want your business, so in order to lure you away from their competition, they will try to offer incentives to become their customers. And second, it encourages people to use their credit cards to pay for purchases, even if they can pay it off with cash, because rewards cards tend to offer points based upon every dollar you spend, or whatever the currency is in your country. This encourages people to use the card for all of their purchases. And the funny thing is, studies have shown that when people buy on credit, they tend to spend more money than they do if they're buying with cash. Now, all of this has helped change the way people use credit cards over the years. Credit cards were traditionally only used for major purchases, but today they're used the same way cash is, even for very minor purchases. I mean, you may see someone at the supermarket use a credit card to buy a tomato for 25 cents. Ridiculous, yes. Does it happen? You know it does. This benefits credit card companies because anytime someone fails to pay off these bills by the end of the month, they're going to owe the credit card company some extra money based upon the APR. So it's definitely a way to increase people's debt. But still, rewards cards have become incredibly popular, and what they offer can vary drastically. So with rewards cards, the cardholder will usually rack up points for whatever money they spend using their cards. And when they accumulate enough of these points, they can usually cash them in for, whatever rewards the credit card is offering. Sometimes these points are even doubled for certain purchases. This helps influence what the holder buys. So let's look at some of the most popular reward programs today. First, you have your airline miles. Cards that offer airline miles, otherwise known as frequent flyer miles, will offer their customers points for making flight purchases using these cards. Now, traditionally, these points are based on the amount of miles flown. So, for example, if the customer purchased a flight from New York to Miami that covers about 10,090 miles,
or over 16,000 kilometers for all my metric mother lovers out there.
So in this case, the airline might assign a point for every 10 miles traveled, for example, which in this case would be 109 points. However, because of how popular budget traveling is nowadays, and everybody's always trying to find a deal for their vacations, many cards simply offer points on the total amount of money you've spent, regardless of the miles you've traveled. So if the flight from New York to Miami is $379, then you'd get 379 points. Then you have what are called cashback cards. As the title suggests, these rewards actually give the customers some of their money back. Now, some cards may offer this in the form of store credit. In this case, the credit card company usually has certain stores that it partners with, and it'll give you a certain amount off on credit to be spent at any of those partner stores. Now, this benefits the stores because it's essentially giving them new customers who will potentially spend more than the store credit that's been given to them. However, many credit card companies will simply write the customer a check or put actual cash into their account and give them the money back. In these cases, the amount of money a customer gets back varies depending on the credit card. I mean, it's common for many companies to offer roughly between 1 to 3% return, which means $1 to $3 for every $100 spent. And cards often tend to put a limit on how much the customer can actually get back. Then you have point cards. Now, these credit cards offer perks or points based on how much is spent, just like any other card. However, these cards usually have a wider variety of purchases that a customer can use their rewards for. Some of these options may include a complimentary hotel room, or rental cars, or entertainment options like maybe tickets to the amusement park or the theater. I mean, sometimes points cards will have an entire catalog of merchandise that people can buy from.
And it could have anything from luggage to coffee makers to cell phones to toys to pool tables.
In these instances, customers will get, let's say, 1 point for every dollar they spend. And they can look in the catalog and they'll see, a pool table going for about 80,000 points. So the catalogs don't list their merchandise with actual monetary costs. They list them with point costs. This way, the customer knows how many points they have to rack up in order to make the purchase. And it should be noted that usually the things in the catalog can be pretty expensive, all things considered. For example, you may see a sweatshirt for 1,000 points. Well, that's really cool, but it means that you have to spend $1,000 on your credit card in order to get that shirt.
Which may actually only be worth $20. More likely, probably worth $1.75, but who's counting?
But still, it is a nice perk, right? And then you have what are called the premium credit cards. Premium credit cards are considered upscale and are typically reserved for those who have excellent credit.
And those who can afford high credit limits. These are the big baller cards. These are the presidential sweet plastics. You know what I'm talking about.
Typically, these cards are offered to those who have very large salaries and who have lots of money in their accounts and lots of money to spend. The interest on these cards tend to be very high, and they often have sign-up fees which can cost over $1,000. But the perks that they offer also tend to show more expensive tastes, and they can include access to exclusive airline lounges. You might have access to a 24-hour concierge service. You might have a personal assistant.
Or access to exclusive experiences like tickets to the US Open, or the Olympics, or the Super Bowl, or fashion shows.
Plus, many premium credit card customers also
Get subscriptions to magazines written exclusively
for people who use that card. So only people who have this card will get this magazine. It's only for them. Now, beyond the perks, these cards are also very popular as a status symbol because of their exclusivity. Many customers enjoy the perception of having these high-end cards. Because of this, even luxury cards have several different levels or tiers to them. I mean, the gold card was once thought to be the premium credit card in the world, designated only for the elite. But nowadays, although the gold card is still a major step above the average credit card, it's no longer the most exclusive. The platinum card is usually a tier above the gold card.
And the black and purple cards are considered the most elite of them all, at least for now, until they need a tier above purple. After all, theoretically, there could be endless tiers. Why not a rainbow card? Or a double black card, a triple black card, a black on black card, an Oreo card, a Chips Ahoy card, an ice cream sundae card. The hell am I talking about? I started thinking about desserts there for a second. Anyhow, the point being, these cards are available only to a select few. Of course, multiple tiers. The gold card is available to more people than the black card would be, but still there's a level of exclusivity amongst all of them.
Now, on the flip side, you also have what are called secured credit cards. A secured credit card is also known as a pay-as-you-go card. See, when a customer takes on a secured credit card, they must deposit money into an account, and this determines the person's credit limit. It's essentially collateral. So the person's credit limit on a secured credit card is usually 50 to 100% of the amount of money placed into the account. So, in other words, if I put $500 into the account, then my credit limit will be $500. Or maybe if I have some trust, $1,000. Now, these cards are used by people who are trying to re-establish their credit score. The credit score can dip quite low when bills are not paid on time, and especially if they're not paid at all. So people who have had trouble with their credit in the past and maybe can't get a traditional credit card anymore, they can take on a secured credit card as a way to kind of reprove themselves and reestablish their credit score and try to build up some trust so that the money they place into the account is actually a form of security offered to the credit card issuer, the banks usually, protecting them from taking too much loss, since the customer is often perceived as a risk given their poor credit history.
Now, secured credit cards are not typically considered rewards cards, but there is a reward that comes with using them responsibly, which is a restored credit score, and subsequently, eventually, more credit opportunities opening up to you.
So, why are credit cards popular? Well, for one, the convenience, obviously. There's a huge benefit to simply being able to make purchases by carrying around one simple card. especially when that card holds money that you don't really have. You don't need to worry about if you've got enough money in your pocket. If you're shopping out at stores, you just got that plastic card in your pocket, you just whip it out, and there you go. Take care of the debt later. So a lot of people like the freedom that comes with carrying around one card and not having to worry about cash, which was one of the original reasons why credit cards became popular. The Diners Club card becoming popular amongst the very wealthy at that time because they didn't like carrying around cash. Another benefit to credit cards is the security they offer. You see, unlike debit cards, which is a card that you use with your real money attached to it, credit cards generally have fraud protection attached to them. So it offers a safety net that debit cards usually don't have. So in the case of a fraudulent charge, for example, somebody charges your credit card. You know, maybe you get your credit card statement and you see thousands of dollars spent on World of Warcraft DLC. You're like, what the hell is this? And of course, you expect it's probably Uncle Earl again, probably snuck in and stole your credit card number.
I just got the credit card statement in the mail.
So?
How did you spend $380 on iTunes?
I don't know. It wasn't me. It was probably you.
But you're not sure. Only thing you know is it's not something that you intended to buy. It's not something that you did buy. It's not something that you wanted to buy. You get screwed over somehow, some way. You can report it to the credit card company and they will research it, look into it. And if they find that there were some shenanigans, they will remove the charge from your credit card. And thus you are no longer liable for that charge. Credit card companies are often pretty helpful in the cases of fraudulent charges. And it's pretty easy to dispute unfair or incorrect charges because credit card companies have departments designed to investigate that sort of thing. Debit cards don't offer the same levels of protection because you're not collecting debt. You're not paying any kind of interest on a debit card, so nobody's making money off of you. When you pay with a debit card, you're paying with real money. Nobody's lending you money, you're just taking your own cash. So when you're using a credit card, you're paying with other people's cash, and they have an incentive to protect their cash. They don't have an incentive to protect yours. So when a credit card company is ripped off, they usually have the means to absorb the loss if necessary, but they usually also have the ability to track down the money and get it back through legal means when it's possible.
Where's my money?
Credit cards also offer insurance, or at least some of them do. See, a lot of people don't know this, but a lot of times when you purchase something with a credit card, the credit card companies are insuring the purchase for you. So, for example, when someone rents a car, the rental company usually offers them insurance at a high surcharge. However, if you rent a car with your credit card, a lot of times the credit card insures the rental for you. So the extra insurance may not be necessary because the credit card itself might have already insured it through their credit card. Credit cards may also offer travel insurance or even additional warranties on things that you buy that go beyond what the manufacturer's warranty may offer. So there are definitely some perks to using the credit card, or at least using some of them, right? Different cards have different perks. And of course, you can always use them to establish your credit history as well. I mean, using credit cards are one of the faster, easier ways to establish and build up your credit score. But remember, you can only do that if you use them responsibly. You have to show people that you're responsible in order to increase your credit score. Of course, if you don't use it responsibly, then it will work in the opposite way and you'll lower your credit score. So, although using a credit card has some perks, it can also come with some extreme dangers, and those dangers tend to befall countless victims every year. The biggest danger, of course, being the threat of overspending. And this is why it's imperative to remember that credit cards are an extension of your own savings. Okay? People who take out credit cards should always make sure to try their best to pay the balance in full on time, because doing that will help you avoid the fees. And this way, you can take advantage of the perks that the cards offer you, take advantage of improving your credit score, but you don't take the risks and you also make sure not to overspend. Spending more than you can afford is probably the greatest danger of all. Remember, credit is not free money. It's real money that you must really pay back immediately, or else it starts to become very expensive money. Very, very, very expensive money. And that may be a price you might not want to pay.